So if you just look at the polling, the recent one before the election, around 25% of US voters named inflation specifically as the single biggest concern they have. And despite the economy doing reasonably well in the US, around 60% of voters described it as being in a bad state. So there is kind of a divergence between the reality and the perception of it.
This is Converge, a podcast from Canberra. Come with us as we shape the future of finance.
We are back for another Converge market update. It's great to have one today. Obviously, it's a week post-U.S. presidential and Senate elections and House elections. Many elections across the country went down last week. So, Boris, it's official. Donald Trump will be the next president of the United States for a second time. The anxiety was extremely high going into election night for a lot of folks. Investors certainly were hedging their bets, buying protection against price swings on the markets. But in the end, it was not really as close as polls would have suggested. So what exactly happened there?
Yeah, hi Alex, great to be back. So I think, as you said, there was a lot of anticipation going into the election. And we had these two candidates that could not really be any more different from each other, not only in terms of rhetoric and style, but also when it comes to the actual policy recommendations they've laid out over recent months or so. And President-elect Donald Trump has decisively won the presidential race by getting these 312 votes in the Electoral College. He did also secure all 7 swing states, which was surprising, and the Republicans also took both chambers of Congress. So it was really a red sweep for the party after all. And as you mentioned, this was not something the polling would have suggested in the beginning, but we have extensively talked about financial markets and betting markets on the other side, moving slowly but surely into this direction as early as the end of September. So the shock was minimized by investors already starting to price in such a scenario some weeks before the election, which was then called the Trump trade. And this Trump trade continues to ripple through global markets, but especially US markets as we speak. These expectations of tax cuts, the deregulation wave, tariffs being imposed next year, they've all pushed the US dollar close to a one-year high, while trade-sensitive currencies, especially the euro and the yuan, are being sold off. US equities, on the other side, continue to outperform their global peers. The S&P 500 is up a staggering 25% year-to-date, compared to the 5% gain on the European benchmark. So I think it's truly a bet on US exceptionalism continuing into 2025 and to a certain extent beyond that as well.
And of course, it's interesting how resilient U.S. equities have been in the face of the election uncertainty. But I suppose the Republican trifecta and the policy change that comes with that should be sort of a tail risk for the U.S. stock market, at least in the short term. Last question on the election result before we focus on markets again. In our last episode, you said that inflation will decide the election. Is it possible to explain the results just by looking at the economic picture?
That is a good question, Alex. So just as a reminder to set the scene for us, inflation has probably been the most polarizing economic development that actually came out of the pandemic era and these government stimulus measures that we had. And I still think that is the main reason why Donald Trump secured a second presidential term, according to both polling and economic models. So if you just look at the polling, the recent one before the election, around 25% of US voters named inflation specifically as the single biggest concern they have. And despite the economy doing reasonably well in the US, around 60% of voters described it as being in a bad state. So there is kind of a divergence between the reality and the perception of it. And Oxford Economics, I think, did a really fantastic job with their so-called inflation sticker shock model, where they try to predict the Electoral College with inflation as kind of the only input variable. And they actually got all but one state right. So while issues like immigration and abortion were still important, the economic picture and the economic headwinds for the Democrats probably were just too hard to overcome in the end. And I would even argue that this extends well beyond the US. We had elections in India, in Germany, in France, in the UK as well. And those elections all had the same result, namely that 2024 will probably go down into history books as kind of the first year on record in which every single government party lost power or popularity in an election. And I think global inflation at 40-year highs in 2022 is certainly to blame for it.
So the phrase, "it's the economy, stupid," that was coined in the 90s is still applicable for explaining politics today, it sure seems. But going back to those markets, you already mentioned U.S. stocks outperforming and the dollar pushing higher. Is this a theme that you actually see continuing into 2025? And what are investors looking out for next?
Yeah, well, I would certainly say that we are seeing some exhaustion of the Trump trade right now. US equities are catching their breath. Investors are taking some chips off the table, so to speak. But most of the information that we currently have on the new administration seems to be priced in. But as you rightly pointed out, the next step now for us is watching out for the new appointees of the administration, but also gauging which policies are really likely to be implemented and which ones were just promises in the campaign trail. And Trump, for example, has asked Robert Lighthizer, the tariff czar, how he was dubbed, to be his trade representative. And he was the one holding that position in the first presidential term of Trump as well. Marco Rubio, on the other side, is said to be the pick for the Secretary of State. And these two were actually somewhat market moving last week because both are seen as China hawks, which, in our opinion, increases the probability of tariffs actually being imposed under Trump next year and in 2026. As you know, the president-elect has floated the idea of a 60% China tariff, a 20% broad tariff on the rest of the world. And this would be his most influential policy on the trade front, at least, when it comes to the impact on FX markets. As you know, the Republicans do have full reign when it comes to setting policy, with the White House being in charge of them and Congress in their hands as well. So tariffs are very likely to be implemented. And same goes for domestic policy, such as extending the tax cuts, for example, lowering the corporate taxes, and so on, which is one reason for why the recent equity rally in the US has strengthened in recent time, and why it didn't really extend to the rest of the world, because it's mainly a US exceptionalism theme.
Yeah, so this does tie into your thesis of the world becoming more fragmented and uncertain as politics inserts itself into economic life. Do you think that U.S. exceptionalism is or could come to the detriment of other regions heading forward?
I think that is what markets are trying to price in, yes. How we explain it to clients is that these calm geopolitical waters that we have had for many decades up until now, they are becoming more volatile. So around 2,000 industrial policies have been implemented just after 2021 alone. And most of them are highly trade distorting and heavily centered around these big regions of growth, the North America, Europe, and East Asia. In China, we have talked about China a couple of times over the last months on this podcast. China has been the biggest culprit of this practice of subsidizing its industry over the past 20 years. But both President Trump and Biden have pushed industrial policy back to the top of policymakers' agenda in the US itself. So if you just look at manufacturing construction spending in the US under Biden, it really undertook a renaissance in how much onshoring there has been under the last president, especially in the last 2 years, because of the government actively promoting onshoring to the disadvantage of non-US companies. I think just to name two bills, the Inflation Reduction Act was a big one, and the second one was the CHIPS Act. And the US isn't alone on that matter. So Europe had its own CHIPS Act that it enacted last year. China continues to subsidize its high-tech industries. So in a big sense, I would say we are moving back into a world where governments see trade morphing from a win-to-win game to a zero-sum game, where one subsidies are the loss of another one. And even talking or taking this point beyond tariffs, if the policies implemented under Trump lead to higher debt issuance, like is expected, to higher inflation, and therefore less rate cuts by the Fed, this would also, in turn, decrease the room for policymakers in emerging markets to navigate, because they would see higher yields and a lack of room to navigate lower interest rates. So it really has an effect on the whole world.
I see. And I suppose open and trade sensitive regions will be more hit by this structural change?
Absolutely. I think we already mentioned emerging markets that are always kind of big focal points when it comes to US policy and their impact of them. But Germany, for example, in particular, has been on the less fortunate side, let's say, of all these structural shifts that we have been talking about. Because Germany was both hit by the US and China shifting to a more regional industrial policy, benefiting their domestic production base, and by the Russian invasion of Ukraine, leading to higher energy prices, which is still not back to pre-war levels. And even if we get a ceasefire under Trump, like promised, the energy decoupling away from Russia, the closing down of diplomatic ties with Russia, this will be a lasting legacy of the war that will be felt over many years to come. So Germany has really lost its cheap energy to Russia. Its diplomacy with China is becoming more complex, which is why I think one chart that we have really prominently shown over the last couple of months is the uncertainty index for Germany being well beyond anything we have seen in other developed markets over the past couple of months. And the government, to add matters, to make matters worse, is also currently going through a crisis. So the chancellor has fired his finance minister, and this will lead to a vote of confidence in December, and then to a likely new election at the beginning of 2025, especially at a time when you would need a government, a stable government and flexible policy to kind of counteract all these headwinds that are coming from China and the US. So I think, or in our opinion, no matter how the election turns out at the end of 2020, at the beginning of 2025, our view is that we will get a tilt in Germany towards more national and industrial policy, akin to the ones we are now seeing in China and the US.
I see. How does this change our views on the euro, particularly? There's been a lot of talk about euro USD falling to parity in the wake of the Trump win. Is this sort of our base case now, in your opinion?
Yeah, so I wouldn't say it's our base case, but the probability of the euro trading at parity against the dollar over the next months has definitely increased. The Republican trifecta is one issue many cite as a downside risk. The prospects of tax cuts in the US, deregulation, they're all leading to US equities outperforming European assets. And this is kind of the one side of just looking at equities. But even on the FX side, likely tariff increases under Trump are definitely pushing investors away from the euro and into the hands of the US dollar. And so this is kind of the foreign perspective that is seen as a headwind to a rise of the euro. But even on the domestic front, again, I already talked about the political turmoil in Germany. This is leading to these growth expectations for next year being subdued. And even now investors feeling more comfortable pricing in a 25 basis point rate cut by the ECB in December, which is, again, still a debatable thing for the Fed or the Bank of England, which, we see a 50-50 chance of this happening. So the ECB is the outlier in terms of leading this dovish shift. And this is, of course, leading to the euro being, at least now, being sold off. So euro dollar is, in a sense, being hit twice. First by US exceptionalism and second by European underperformance. So long story short, we do see the euro falling a bit further to around 103, 104. But the probability of hitting parity this year, I think, is still not our base case.
I see. Interesting. I'm sure our audience appreciates us covering some of the global macro narrative and the changing geopolitical landscape. But as a final question before we wrap up, let's look at the risk event of this week. We just had the US inflation figure for October released. What's your key takeaway from that?
Yeah, thanks for giving me the chance to talk about the inflation print, because always important to strike a balance between these long-term narratives that are certainly important for our clients, but also the short-term risks associated with FX trading. So I think as a short summary, US inflation did come in as expected across the board. Headline inflation rose from 2.4% to 2.6%. Core inflation remained at 3.3%. But because the rise was expected, we didn't really see a negative reaction to it. So investors seem to be fine with this progress in disinflation stalling, as long as we don't get the signs of a significant rebound in the short term. And the print, in my opinion, doesn't really change the reaction function of the Fed too much. We still see policymakers slightly cutting interest rates by 25 basis points next month, which would bring the total easing for 2024 to around 100 basis points. They just have to be careful, I think, not to become too complacent about inflation, because inflation expectations and bond yields in the US are back on the rise, and they have been ever since, ironically, the Fed started easing policy in September, but especially since Trump got elected. So Trump will most certainly add, I would say, another layer of complexity or uncertainty to the Fed's decision-making. But for now, just looking at the December meeting, we still expect Trump not to be a factor in terms of how the Fed decides its policy. And this is why we still see the 25 basis point cut as the base case. But as we move into next year, I think the first projection that we get in March from the Fed will already start incorporating some of the assumptions the Fed has in terms of what Trump will do on the trade front, but also the domestic policy front.
All right, great, Boris. Really thorough analysis. Great to have you break it all down in this seminal week post-U.S. election. Thanks again. We'll have you back in a couple of weeks to check in on how things are looking.
Yeah, awesome. Alex, always a pleasure.